There are an awful lot of people today who believe that the stock market is a speculative bubble waiting to burst. They just can't believe it just keeps hitting new all-time highs. As those of you who read my material know, I disagree with this. As a matter of fact, I just did the calculations again last night, and I believe the market is about 18% below its fundamental value at this point. Why am I so different from so many other forecasts? Well, the first thing I do, if I'm going to invest in stocks, is first I want to determine what a real value should be of what I'm buying. You would do that in any other business as well. And the real value of stocks is based on two things. It's based on profits and interest rates. And I have a long-term chart of profits for the S&P 500 index here, from 1946 up to the current. What you can see is there's a strong upward trend to this chart. So we continue to hit new highs in corporate profits. Well, profits are the basis for valuing the stock market. You keep hitting new highs in profits, it only makes sense that you're going to hit new highs in terms of stock prices. So new highs are not unusual. As a matter of fact, it would be unusual if the stock market were not hitting new highs. Second factor you have to consider, because people who consider profits say that the price-earnings ratio, the price-to-profit ratio, is extremely above the long-term average. Well, it's true. But there's a second factor you have to consider, and that's interest rates. When interest rates are low, as they are today, both profits and stocks and any fixed assets are worth more than they are when interest rates are high. And that period where we have the average PE that people refer to in the past, those were periods when we had very high interest rates. And so combining those two factors, I come out, and my conclusion is the market's very undervalued. Now, an undervalued market can still drop very low. This sharp drop in profits, 2008, was the result of the financial crisis. The question becomes, what happened to cause prices to collapse? And could it happen again? And the answer is, what happened is the Federal Reserve made a mistake. It didn't put enough money in the economy. And we had a liquidity crisis. Fed doesn't do that very often. This was the first time since the 1930s that the Fed made a terrible mistake, and a lot of people got hurt in the process. As soon as they discovered their mistake, they started putting money back into the economy, and the recovery resumed. But if you're into the stock market, you've got to be pretty careful about what the Fed is doing, particularly now, because the Fed has told us they're going to start selling off some of their securities, draining some money from the system. Now, if that were the only thing going on, I would be a little concerned. However, there are a number of other factors that may lead to the fact that we do have enough money in the system. Matter of fact, my current view is that there's enough money in the system. We shouldn't worry about it. But what we should do is continue to monitor it. Or what if we don't monitor it? Let's say you were the worst market timer ever. And it was 10 years ago today that the stock market hit an all-time high. And let's say you had $1 million and you had hesitated getting into the market, but you finally decided, I'm going to get into the market now because things have gone so well. Well, 10 years ago, you would have hit a high. So let's say you put $1 million into the market. A year later, depending upon what you put your stocks in or what you put it in the market, if you put it in the S&P 500, you would have $800,000. You would have lost 20% of your money. And if you didn't panic, but you just kept that money in, today you'd have over $2 million.